about technical analysis, one clear cut instruction from my side, which you can follow, and you can make money because of that, and you can avoid doing getting in financial losses because of that as well. So what is that concept? Now suppose that moving average convergence and divergence is a technical indicator. Okay. Now many people use it. In fact, almost everyone who does technical analysis initially uses it, right? Now MACD, moving average convergence and divergence, is based on the moving average system, wherein they take a moving average of 12 days, 26 days, and then 9 days of something. Okay, you don't need to get into that right now. We'll do all of this later. Now the MACD was created, I mean, decades and decades back. I mean, literally kind of centuries back, you can say. Okay. All right. In fact, you won't believe that technical analysis started initially as behavioral finance. Okay. It's a study of the psychology. At the end, markets are driven by psychological beliefs of people, and that is reflected in the price immediately. So fundamental analysts, they say that market is 90% logical and 10% psychological. But technical analyst says that no, market runs through euphoria. Right now, there was a euphoria of IPOs. So have you seen what happened in the IPO market of late? Right? It was all a euphoria. It was a bubble which is now kind of bursting. Those who kind of wanted to make money, they have made their money. Others could not, they could not. So technical analysis says that markets are 90% psychological and 10% logical. No logic prevails in technical analysis. If people are buying, everyone is buying, the stock will go up. It will not follow any fundamentals. It will follow price action, which means if a stock starts going up due to fundamentals initially, from this point to this point, it went up because of fundamental analysis. But from this point to this point, it is going to go up because of the psychological beliefs of people and fear of missing out. People will have a fear of missing out. So people will think, मेरा ये बस मिस हो गया, ट्रेन मिस हो गया, अभी मेरे को अगली बार जब नया ट्रेन आएगा मेरे को जाने का. So they say that if you can tap the psychology of the investors, you can make and mint big money in technical analysis. So there was this technical indicator. I mean, in the 12th, 13th century, the Japanese people, they used to do rice trading. And that rice trading they used to do using technical candlestick patterns. They used to draw it on stones, okay, using stone and coal and all that. They used to write and scribble all of that. From there, technical analysis has come to this. Now, years ago, there was this MACD which was invented, which says moving average can be calculated based on 12, 26, and 9 days. Now you will see that some modern influencers, YouTubers, social media, I would say kind of technical analysts who have done, who are making it big in the platforms there, they say that no, you should be using 10, 20, and 44 days as MACD, okay, for the base. Basically, this is the base. Suppose you're making a dish. So you always used to make this dish by 40% water, 30% grain, 10% sugar, and 5% salt, 10% this, like that. So this was always the formula. And with that, the taste which comes is phenomenal, right? But there are some new people who say that no. If you add little bit sugar more and reduce the grain portion, if you add some fiber here, if you add some protein here, I mean, they are going to come up with their own versions. Now, I am strictly against improvising in technical analysis. And the reason is that technical analysis works only because it is there in this markets from so many years, 100, 200, 300 years. That's why it's working. You should not touch the parameters which are the default parameters. You should not touch them. So why did they take 12 days average? Because during that time, except Sundays, trading used to happen 6 days per week. So the person who invented MACD wanted to take this as 2 weeks, this as 1 month, if you can understand, 26 days. So barring 4 Sundays, right? 2 weeks, as in 15 days versus 30 days. You can kind of consider it like that. So this is basically 2 weeks versus 1 month. And this was 1.5 weeks, 6 days in a week, so 1.5 weeks. Okay, this was the ratio. Now in today's context, when we have only 5 trading days in a week, this 12 should become 10 rightfully, and around 8 to 9 Saturdays and Sundays, kind of, we have one public holiday on an average. We have once a month, maybe, or something like that. So 20 days represents one month now, and 10 days represents 2 weeks of trading sessions. This is what people say. Now, this is not comparable to this. This is something else. But 10 and 20 is considered superior over 12 and 26 by the modern day technical analyst. I don't agree. Why? Technically, 10 and 20 is more correct because now we have 5 days a week, not 6 days a week. But you are following 12 and 26 because you don't get into these things. You're not aware of this. Your team is following 10 and 20. Those technical analysts sitting in the Western countries, they're also following 12 and 26. Because everyone has read the same old 10-20 books before coming into the world of technical analysis. The same books by Steve Nissen, the same books by all the famous authors of technical analysis. Now, if traditionally we have all studied 12-26, all the softwares are also made as default options. The default options in all the softwares, if you use a technical analysis software, you will see MACD automatically chooses 12, 26, and 9 for you. And then if you want, you can make it 10, 20, and whatever you want. So every person who is doing technical analysis is not that much knowledgeable to think that why 12, why 26, so make it 5 days in today's context. They're not into all of that. Someone told them that if MACD is positive, buy the stock. If MACD is negative, sell the stock.